welcome to the FT headquarters in London. Today we'll discuss the market outlook for 2018, the return of market volatility and how it impacts the asset allocation decisions for private clients' portfolios. Here with me I have Christian Nolting, Global Chief Investment Officer for Deutsche Bank Wealth Management. Welcome, Christian.
Thanks for having me.
Christian, the sell-off in global stocks in early February, when equities plummeted more than 10%, ended a long period of extremely low volatility and strong market performance. The bull market was to celebrate its 9th birthday this month in March. But are we still in a bull market? Do you expect the market rally to continue this year?
So first, you're right. So we have seen 15 consecutive months of positive performance in the S&P 500, and February 18 was the first one where it was negative. I think what we are seeing is somehow the return of volatility to a more normal level. It was really incredibly low in 2017, and now with discussions of the economy overheating, which would cause then interest rates to rise maybe faster than the market was anticipating, volatility is coming back. So I think, does it end the bull market? From our point of view, no, because macro environment still looks okay. Earnings of the equities look okay, but people have to get used to a more normal level of volatility.
And do you view these pullbacks as an opportunity for investors to add to their equity exposure, or is it perhaps the return of volatility will reduce the investors' risk appetite?
So I think people have to understand it's not a one-time effect. We really think volatility will be higher on average over the next months and probably 2-3 years as well. But we think it's an opportunity, yes, because we think the whole cycle is not over and the economy is doing quite well. Yes, that's why I think you can use that kind of volatility.
And do you see any sub-asset classes in equity markets that perhaps have suffered heavily in the recent correction and are standout bargains today?
Well, we think on the developed market side, probably you have to look at Japan, which we find quite interesting. The earnings of the companies do look okay. And we do see, even with the little stronger yen we have seen recently, companies did quite well. So the correlation to the yen has been diminishing. And maybe you can also look at domestic companies in Japan there. And if everyone is wrong and inflation is really going quickly higher, it should not be so negative for Japan, I would say, because they have not had inflation for quite some time. I think that's on the developed market side. We also like Europe from that perspective. On the emerging market side, it's more Asia we really prefer.
And most of the private banks in PWM's Global Asset Tracker survey, which we conducted in January this year, actually see Asian stocks particularly as one of the most attractive asset classes. How important is the role of tech firms in Asian economies, in China in particular, in driving the growth story of Asian stocks and in driving money flows into Asia?
Well, I think it's very interesting to look at market composition. If you just look at MSCI index, for example, Asia ex Japan. 10 years ago, tech was relatively low, below 20%, and now it's roughly 40%. And before it was commodities, and now it's really tech driving the markets. And a lot of people now do passive investments, so they buy into tech. And I think there's a barbell. You have those large tech companies, which are more in the developed markets, and then you have those smaller companies which deliver to larger companies, so you have a barbell strategy. And there, Asia, I think, is quite successful. Because if you look at the earnings of these companies, they look quite stable and are even improving. And that's why I think it's a good reason really to look at those areas.
Bullish Powell, the Fed's chairman, is fueling expectations of faster US rate rises. What's the risk that aggressive rate hikes and dollar strength could hurt Asia particularly hard?
Yeah, first of all, if you think of the Fed, what the Fed needs to watch is certainly growth and inflation. And the discussion in the market is all about, look, it started in February at wages, right, being higher. And I think that's key to watch what happens to wages. What Paul also said, and I think that was really important, if you look at productivity gains in the US, they have been there in the recent years, but it's not as fast as we've probably seen in the 60s, because some compared to the 60s, we also had a period of low volatility and then it spiked. Productivity gains and growth is not that large. And that's why the Fed is not overly concerned about wages. Something to watch because of inflation, but not overly concerned. And that's why I think the probability of a much faster hiking cycle is relatively low. Nevertheless, the market is worried that it could happen and the economy could overheat. What does that mean for emerging markets? Yes, they have been profiting a lot from that situation, but we think even with a slightly stronger dollar or with the Fed hiking more, central banks, especially in Asia, are in a quite good position. And it's, if you compare to recent cycles or earlier cycles, they're in a much better and stronger position than before. And I think that's why it's still a case for emerging Asia.
With growth in China also spreading across the Asian region, do you see attractive investment opportunities in other countries outside China?
Yeah, we also like India because we also see quite steady growth and some very positive reforms from that perspective. And that's why we think if these reforms can continue, you probably see even higher growth in India than in China on an absolute basis. And that's why probably more investors are looking at India as well. So China, India, probably some countries we really want to prefer in Asia.
Mm-hmm. And in the current environment with rising rates and rising inflation, is it more difficult to manage risk in the equity space or in the fixed income space?
Well, I think you really have to watch the fixed income space. How are you positioned there? And there you had a long time bull market, and probably you cannot get very easily positive returns if you look at developed market government bonds this year. That's also what we forecast, 2018, to be different from 17 and the years before. So I think you have to be short duration on the fixed income side. That's really crucial. On the equity side, we are more positive, and we think there can be this year, say, high single-digit gains on average on the equity markets. But you have to live with a little bit more volatility.
Mm-hmm. Corrections of the kind we saw in the early days of February can act as a reminder of the advantage of long-term thinking. Do you believe that an effective way of managing volatility is to invest in cross-sector secular trends which play out over the long term?
Yeah, we like the long-term themes because we think if you, for example, look at the US, we are definitely late in the cycle. So we are watching what can survive future recessions. Of course, there will be impacts. But where are longer-term trends? And they tend to perform late cycle very well. So we identify trends, which is, for example, cybersecurity, which is millennials, as the consumer is probably one of the winners of the cycle. And then you have infrastructure, healthcare. So that's 4 major trends we have identified. On top of this, what clients tell us and what we want to manage for them is then to use these trends, but normally they are high beta and somehow a bit more risky. And that's why to add some risk management on the tails. And so you can balance the portfolio a little bit. The higher risky, but should be quite nice performing longer term trends. And then you have a risk management on the other side. I think that combination makes sense, and that's where we are in the cycle right now.
Automation, robotics and digitization, as well as artificial intelligence, are the most popular investment themes according to our recent Global Asset Tracker survey. Why are these themes so popular with clients? Is it because they expect higher returns from these kind of themes?
Yeah, I think so. But I think clients do understand we are living in massive times of change, right? So we have certainly this industrialization 4.0. And I think you can invest in this. I think this trend is far from being over, and that's why I think it makes sense to look into this. Still, you have to risk manage your portfolio. So if you put everything in that space without hedging, then of course it will be creating higher volatility.
Mm-hmm. So if you had to give 3 key recommendations to clients in how to manage their portfolios or manage volatility in the current environment, which ones would they be? 3
recommendations, I would say work heavily on your fixed income side. Don't expect fixed income to always deliver positive returns. On the equity side, live with higher volatility, but we think we are positive on equity, so it should be a good outcome. However, also risk management in the equity side, and you can do this with simple puts, but you need to look at the whole risk structure of the portfolio. So work on fixed income, positive on equities, but risk management is key with higher volatility.
Thank you very much, Christian, for your insights.
You're welcome.